Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about RPM International Inc. quarterly report. RPM International Inc. offers a diverse range of businesses and services across various markets. In the construction market, the company provides waterproofing systems, coating solutions, roofing materials, and building maintenance services. It also offers concrete repair and protection products, as well as sealants, adhesives, and tapes. In addition to these offerings, RPM International Inc. provides specialized products for the manufacturing industry, including fire-stopping and intumescent steel coatings. The company's consumer segment includes a wide range of products such as nail enamels, polishes, and coating components, as well as paint contractors' supplies. RPM International Inc.'s Specialty Products Group (SPG) offers a variety of products for the industrial market, including fiberglass reinforced plastic gratings and shapes, corrosion control coatings, and specialty construction products. The company's PCG segment provides concrete and masonry admixtures, cement performance enhancers, and curing compounds. The company also offers services such as fire and water damage restoration, carpet cleaning, and disinfecting products through its consumer segment. Overall, RPM International Inc.'s diverse range of businesses and services cater to various markets and industries, making it a leading provider of specialty chemicals and solutions. RPM International Inc. maintains a market capitalization of $14 billion, broadly in line with the industry peer group. RPM International Inc. trades at a higher price-to-earnings ratio of 21 times and a higher price-to-book ratio of 4.45 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The leverage on the balance sheet appears elevated, with liabilities of 63% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have increased over the past 5 years, which is normal for a growing company. Asset and equity growth have outpaced liabilities, suggesting balanced and healthy expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline can be identified through an analysis of the company's financial performance. On the positive side, the CPG segment experienced significant revenue growth, with a $52.8 million increase in net sales over the 3 months ended February 28, 2026. This growth was driven by broad-based expansion across various product lines, including turnkey flooring solutions and protective coatings. In addition to the CPG segment's strong performance, the Asia-Pacific region also saw revenue growth of 14.3% year-over-year in 2026. The PCG segment also experienced growth, albeit at a slower rate than the CPG segment, with an 8.7% increase in revenue over the same period. However, not all segments performed well. The PCG segment's revenue declined by 33.1% in the United States compared to the previous year. This decline was largely due to softness in DIY markets and product rationalization in the consumer segment. Furthermore, a significant jury verdict against a subsidiary resulted in a $190 million decrease in revenue. Overall, the company's revenue growth or decline can be attributed to a combination of factors, including geographic expansion, product line diversification, and market conditions. Net income experienced a decline of $23.4 million for the 9 months ended February 28, 2026, compared to the previous year. This decrease was also reflected in the 3-month period, where net income dropped by $700,000. Profit margins underwent changes as well. The gross profit margin, GPM, saw an increase from 41.1% to 40.9% for the 9 months ended in 2026, but a slight decrease from 38.5% to 39.4% for the 3-month period. Conversely, net income margins (NIM) decreased from 8.8% to 7.8% for the 9 months, and from 3.5% to 3.2% for the 3 months. The reasons behind these changes are multifaceted. While cost inflation and increased restructuring expenses partially offset some gains, improved sales and fixed cost leverage contributed positively due to higher volumes and operational improvements from MAP 2025 initiatives. Additionally, savings from 2026 restructuring actions also played a role in mitigating losses. The company's financial performance indicates a strong ability to generate cash from its core operations. According to the provided information, the company has consistently demonstrated positive operating cash flow in recent years. Specifically, the data shows that cash provided by operating activities reached $656,672 in 2026, signifying a significant influx of funds generated from the company's day-to-day activities. This trend is further reinforced on page 51, which also confirms the company's ability to generate positive operating cash flow. The consistent generation of positive operating cash flow suggests that the company has a solid foundation for its financial stability and growth prospects. The company's financial situation has undergone significant changes in recent years. A notable increase in long-term debt is evident, with a rise from $2,555,487,000 to $2,646,613,000 between two specified periods. This growth in debt level is further supported by the fact that financing activities have increased significantly, with $366 million used in 2026 compared to $294.2 million in 2025. In terms of interest expenses, a substantial increase has been observed. The interest expense has risen by $3,954, 14% increase, from $22,993 to $26,947. This trend is consistent across multiple reports, with other mentions indicating an increase of $3.9 million and $13.7 million in interest expense. These changes suggest that the company's debt level and interest expenses have indeed undergone significant alterations. The performance of various segments and regions within the company has been a mixed bag. On the positive side, the Personal Care Group, PCG, consistently outperformed its counterparts, boasting higher income before taxes throughout the period. The CPG segment also showed promise, with an organic sales growth of 6% and net sales totaling $2,165.6 million. However, not all segments fared as well. The consumer segment experienced a decline in organic sales of 3.4%, resulting in net sales of $1,896.9 million. Furthermore, the CPG segment's income before taxes was lower than that of the PCG segment in some periods, indicating areas where improvement is needed. Overall, these results highlight the need for targeted strategies to address underperforming segments and capitalize on the strengths of others. Management is anticipating inflationary pressures throughout fiscal 2026 and into 2027. To offset this, they plan to invest in growth initiatives, including MAP 2025, while also implementing cost-saving measures through pricing and procurement efficiencies. The company aims to eliminate unnecessary costs by realigning resources with strategic priorities. This will be achieved through structural changes and the rationalization of their footprint. Improved pricing is also expected to help recover inflationary losses. Management acknowledges that restructuring costs will continue in 2026, totaling approximately $12.3 million as part of the MAP 2025 initiative. However, they expect long-term benefits from these investments, including improved sales and operational efficiencies. The company remains committed to investing in growth initiatives and improving operational efficiency. They are also exploring opportunities for organic expansion or acquisitions in foreign jurisdictions using undistributed earnings held at their foreign subsidiaries. The company has made several strategic acquisitions and divestitures in recent times. In terms of acquisitions, the company has expanded its portfolio through various deals. Notably, it acquired Star Brands Group, which is expected to bring significant benefits to the business. Additionally, the company has made acquisitions in the consumer goods, CPG segment, personal care goods, PCG segment, and consumer segment, all of which are expected to contribute positively to its revenue. Furthermore, these acquisitions have also led to additional expenses, with SG&A costs increasing by $1.9 million in CPG, $1.4 million in PCG, and $13.7 million in the consumer segment. Despite these increased costs, the company is optimistic about the long-term benefits of these deals. On the other hand, the company has also made significant divestitures as part of its MAP 2025 program. This includes the sale of 3 properties in the consumer segment for a total of $4.4 million. Additionally, the company has closed several plants as part of this program, which is expected to improve operational efficiency and reduce costs. Overall, these acquisitions and divestitures are key components of the company's growth strategy, aimed at expanding its portfolio, improving operational efficiency, and reducing costs. The company has demonstrated its commitment to returning value to shareholders through both dividend payments and share buybacks. In terms of dividends, the company paid out $202,789 in cash as a dividend in 2026. This indicates that the company is prioritizing shareholder returns. In addition to dividend payments, the company has also been actively buying back shares. The company's stock repurchase program has a maximum dollar amount of $139.8 million as of February 28, 2026. Over the course of several periods, the company has repurchased a significant number of shares, including 152,426 in the 3 months ended February 28, 2026 and 246,321 at a cost of $25 million on page 43. These share buybacks demonstrate the company's confidence in its financial position and its commitment to maximizing shareholder value. Overall, the company's dividend payments and share buybacks suggest that it is prioritizing shareholder returns and demonstrating a strong commitment to creating long-term value for its investors. That concludes the financial summary for RPM International Inc. Feel free to comment below, and I will be happy to answer them when possible.